There are rare moments in economic history when the rules of valuation change almost overnight. Not the rules of arithmetic, not the rules of basic business logic, but the rules that govern which companies deserve to be worth more than others, which industries carry the future in them, and which are quietly becoming something the market has not yet recognized as obsolete. The invention of electricity was one such moment, not because electricity was new, but because the moment it became cheap, reliable, and universally distributed, it stopped being a curiosity and became infrastructure. Suddenly, every business that had been built around the economics of muscle and fire had to reckon with a new cost structure. Some companies adapted and became giants. Others simply disappeared, not in dramatic bankruptcies, but in the slow and forgettable way that things become unnecessary. The rise of the internet was another such moment, and again, the pattern repeated. A technology that had existed for years in laboratories and universities suddenly crossed a threshold of usability and cost, and the entire map of business value had to be redrawn. Some investors saw it early and made fortunes. Many others saw it clearly, but bought at the wrong time, in the wrong companies, and lost fortunes instead. And a great many people simply watched from the sidelines, convinced that something this dramatic could not possibly be real, only to spend the rest of the decade wishing they had paid closer attention. Artificial intelligence is that moment, right now, in the years you are living through. But here is what makes this moment different and more dangerous from an investor's perspective. Electricity and the internet were relatively easy to see in the economy. You could watch factories get wired. You could count internet service providers. You could see the physical infrastructure being built. Artificial intelligence is different because it is not just one thing. It is not a product you can hold or a service you can subscribe to in a simple way. It is a capability, a general purpose capability, that is being woven into the fabric of every industry simultaneously. It is changing the cost of writing software. It is changing the cost of discovering drugs. It is changing the cost of designing products, processing legal documents, managing financial risk, analyzing satellite imagery, and answering customer questions at 3 in the morning in a language the company's employees do not even speak. This means that the investment challenge is not simply, which AI companies should I buy? The challenge is deeper and stranger than that. It is, how do I think about value in a world where artificial intelligence is restructuring the cost of almost every economic activity at once? That is the question this book exists to answer. And the first thing this book will tell you is that the answer is not simple, but it is learnable. It requires a framework, a way of thinking, not a list of ticker symbols or a set of predictions about which company will win. Markets are too complex for confident predictions. But markets reward clear thinking, and clear thinking about artificial intelligence is rarer than you might expect, even among professional investors. So let us begin to build that thinking together. We will start with the most fundamental question of all, the question that will guide everything else in this book. When a technology as powerful as artificial intelligence arrives, which companies actually benefit? Not which companies mention it in their press releases, not which companies use the word in their earnings calls, but which companies are structurally positioned to capture real, lasting, compounding value from this transformation. That question is where Chapter 1 begins. And the answer, when you understand it fully, will change the way you read every financial report, every industry analysis, and every investment thesis you encounter for the rest of your career as an investor. Turn the page. The repricing has already begun. Chapter 1. Which companies actually benefit from AI? Every major technology wave in history has produced the same mistake among investors, and that mistake is not skepticism. Skeptics at least protect their capital. The most costly mistake is the opposite. It is the assumption that every company connected to a powerful technology will benefit from it equally. This assumption is almost never true. And in the age of artificial intelligence, it will be wrong in ways that are particularly expensive to discover after the fact. So let us begin with a foundational principle, one that will run through this entire book like a thread. The presence of artificial intelligence in a company's business is not, by itself, a reason to invest in that company. What matters is the relationship between AI and that company's specific economic structure, its cost base, its revenue model, its competitive position, and its ability to translate AI capability into durable advantage. With that principle in mind, let us map out the landscape. The four positions. When artificial intelligence arrives in an economy, companies tend to fall into one of four positions. Understanding which position a company occupies is the first analytical step in evaluating any AI-related investment. The first position is what we might call the enabler position. These are companies that build the tools, infrastructure, and raw capabilities that make artificial intelligence possible. They sell shovels, to use the old gold rush metaphor. They make chips. They run data centers. They develop the large language models. They provide the cloud computing resources that AI systems require at massive scale. When every industry rushes toward AI adoption, these companies see demand from everywhere at once. Their revenue is not dependent on any single application of AI succeeding. What they need is for the overall adoption curve to keep climbing, and in the current environment, there is substantial evidence that it will. The second position is the integrator position. These are companies that weave AI deeply into their existing products and services in ways that make those products substantially more valuable. Think of a software company that embeds AI assistance directly into its workflow tools, not as an add-on, but as a core feature that changes the fundamental value proposition for the customer. Or a healthcare company that uses AI to dramatically shorten drug discovery timelines, which changes the economics of their pipeline. Integrators do not just mention AI, they restructure their business around it in ways that are difficult for competitors to replicate quickly. The third position is the beneficiary position. These are companies that gain from AI adoption without necessarily using it themselves in a sophisticated way. A company that sells the physical materials required to build AI data centers, for example. Or a company that provides specialized legal or consulting services to the AI industry. Or a utility company that supplies the electricity that AI infrastructure consumes in enormous quantities. These companies benefit from proximity to the AI economy without being AI companies themselves, and they are often overlooked by investors who are focused only on the obvious names. The fourth position is the disrupted position. These are companies whose existing business models are weakened or made obsolete by AI. This is not always obvious from the outside, and it is rarely acknowledged by the companies themselves. A company that employs thousands of people to perform tasks that AI can now perform at a fraction of the cost is not necessarily in immediate danger, but it is carrying a structural vulnerability that the market will eventually price in, whether the company's management acknowledges it or not. We will return to the disrupted position in detail in Chapter 8, because understanding which companies are quietly being threatened by AI is just as important for an investor as understanding which companies are being empowered by it. But for now, let us focus on the three positions of advantage. What real benefit looks like. Here is a test that separates real AI benefit from narrative AI benefit, and the difference is worth understanding carefully. Real AI benefit shows up in measurable financial outcomes. It shows up as lower cost per unit of output. It shows up as faster product development cycles. It shows up as higher revenue per employee. It shows up as improved customer retention because the product genuinely works better. It shows up as a widening gap between the company's capabilities and those of its competitors who have not yet adopted AI at the same depth. Narrative AI benefit, by contrast, shows up only in press releases and earnings call language. It shows up in phrases like, "We are leveraging artificial intelligence across our platform." It shows up in announcements of AI partnerships that do not yet have revenue attached. It shows up in stock prices that have risen in response to association with AI rather than in response to any fundamental change in the company's economics. The investor who cannot tell the difference between these two things is the investor who buys the narrative and sells at a loss when the narrative fails to translate into numbers. So how do you tell the difference? You look for specificity. Companies that are genuinely benefiting from AI can tell you exactly where the benefit is showing up. They can say, "Our AI-assisted customer service system has reduced our support cost per ticket by a measurable amount," or "Our AI code generation tool has allowed us to ship features at a faster rate." They can show you the numbers. They can explain the mechanism. Companies that are merely telling a story cannot do this. They speak in general terms. They promise future benefits that are always just around the corner. They announce initiatives rather than results. This is not a foolproof filter. Some companies genuinely are in early stages of AI integration and cannot yet show full results because the investments are still being made. But even in those cases, good management teams will be specific about what they are building, why they believe it will create value, and what metrics they will use to measure success. Vagueness is a warning sign, not an invitation to give the benefit of the doubt. The moat question. There is a second test that matters enormously for AI investment, and it goes beyond the simple question of whether a company benefits from AI. The question is whether AI strengthens or weakens the company's competitive moat. A competitive moat, to use the language of Warren Buffett, who popularized the concept, is the durable advantage that protects a business from competition over time. It might be a brand. It might be a network effect, where the product becomes more valuable as more people use it. It might be switching costs, where customers find it difficult or expensive to leave. It might be proprietary data, which is particularly relevant in the age of AI. It might be regulatory advantages or intellectual property. The critical question for AI investing is, does artificial intelligence make this company's moat wider or narrower? For some companies, AI dramatically widens the moat. A company that already has a vast proprietary dataset, for example, is in a position to train AI systems that its competitors simply cannot replicate because the competitors do not have the data. The moat was already there, but AI turns it from a moderate advantage into an enormous one. For other companies, AI narrows the moat. A company whose competitive advantage came primarily from having a large and skilled workforce to perform complex analytical tasks may find that AI reduces the value of that advantage because competitors can now access similar analytical capability without building a similarly large and expensive team. And for some companies, AI eliminates the moat entirely. If your entire value proposition rests on doing something faster or more cheaply than your competitors, and AI allows your competitors to do it faster and more cheaply than you can, your moat does not just narrow, it disappears. These are the companies that represent the most dangerous investments in the AI era because their vulnerability is structural, not operational. You cannot fix a structural vulnerability by hiring a new management team or cutting costs in the short term. You can only fix it by reinventing the business, which is difficult, expensive, and uncertain, and which most established companies do not manage to do successfully. Industry by industry. Let us now walk through several major industries and think carefully about where the AI benefit actually flows. In the financial services sector, the companies best positioned to benefit from AI are those with large proprietary datasets, complex analytical needs, and the technical infrastructure to deploy AI at scale. Quantitative trading firms that have been using machine learning for years are not going to suddenly transform their business in response to the new generation of AI. but they may find that new capabilities accelerate what they already do. Banks that can use AI to dramatically improve fraud detection, credit risk modeling, and customer service are gaining real cost advantages. Insurance companies that can use AI to price risk more accurately are building genuine competitive advantages, provided they have the data to train the models. But the gains in financial services are not evenly distributed. A community bank with limited technical staff and no data science capability does not benefit from AI in the same way as a global investment bank with thousands of engineers. The AI wave in finance, as in other sectors, tends to amplify existing advantages, which means the strongest players often get stronger and the weakest face increasing structural pressure. In healthcare, the AI opportunity is enormous, but the timeline is uncertain. Drug discovery, medical imaging analysis, clinical trial design, and patient outcome prediction are all areas where AI is demonstrating real capability. But the healthcare sector is regulated in ways that slow deployment, and the clinical validation required before AI systems can be used in actual patient care is extensive and time-consuming. An investor who is excited about AI in healthcare needs to think carefully about timing. The value is real, but it may take longer to translate into financial results than the market sometimes assumes. In manufacturing, AI is being used to optimize production processes, predict equipment failures before they occur, improve quality control, and reduce waste. These are real, measurable improvements in operational efficiency. A manufacturer that successfully deploys AI in its production systems is a company with lower costs and higher margins, which is exactly what makes a business more valuable over time. In retail and consumer goods, the AI benefit is concentrated in areas like demand forecasting, supply chain optimization, personalized marketing, and customer service automation. The companies that are executing well on these applications are seeing real improvements in inventory management and customer lifetime value. But consumers themselves are also using AI to make purchasing decisions, to compare prices, to find alternatives, and to research products in ways they never could before. This means that brand loyalty, which was always a form of competitive moat, may be weakening in some categories as AI makes it easier for consumers to identify the best value option regardless of brand familiarity. In professional services, the picture is complex and important. Law firms, consulting firms, accounting firms, and similar businesses that have historically charged high fees for the time of highly trained humans are facing a fundamental question about their cost structure and value proposition. If AI can perform tasks that previously required a junior lawyer or a junior consultant, what happens to the business model that depends on billing for those hours? We will examine this in depth in Chapter 6 and Chapter 7, but the headline is this: some professional services firms will use AI to become dramatically more efficient and profitable. Others will find that AI undermines the very basis on which they charge their fees. The question of timing. One more dimension matters enormously in this first chapter, and that is the question of timing. The history of technology investing is littered with cautionary tales of investors who understood a technology correctly, bought into real companies with genuine advantages, and still lost money because they were early. Being early in an investment is, in practice, indistinguishable from being wrong, at least in the short run. Artificial intelligence is a powerful and genuine technology. The companies that are enabling it, integrating it, and benefiting from it are real. The economic transformation it is driving is real. But the market's enthusiasm for AI has already priced in significant future growth for many of the obvious names. This does not mean those companies are bad investments. It means you need to think carefully about what is already reflected in the price and what represents additional upside. This is the subject of the next chapter, and it is perhaps the most practically important subject in this entire book, because understanding what a company is worth versus what a company's AI story is worth in the current market is the skill that separates disciplined investors from those who are simply riding narratives. The story of artificial intelligence is one of the most powerful investment narratives of our era. But stories and value are not the same thing. Learning to distinguish them is where the real work begins. Chapter 2: AI Revenue versus AI Hype. Let us be honest about something that makes AI investing genuinely difficult. The narrative around artificial intelligence is extraordinary. The language used to describe it by technology companies, by venture capitalists, by financial analysts, and by the media is often superlative, transformative, revolutionary, once in a generation, unprecedented. Some of this language is accurate, some of it is marketing. And the investor's job is to figure out which is which, not after the fact, but in advance, before capital is committed. The central skill required for this is the ability to distinguish between AI revenue and AI hype, between the money that is actually flowing through businesses because of artificial intelligence and the money that investors are paying in anticipation of flows that have not yet materialized and may not materialize on the timeline or at the scale that the market is currently assuming. What counts as AI revenue? Before we can evaluate AI revenue, we need to be precise about what it means. AI revenue is revenue that would not exist or would exist in a substantially smaller amount without artificial intelligence. It is revenue that is directly attributable to an AI capability, not revenue that happens to occur in a company that also has an AI strategy. This distinction sounds obvious, but in practice, it is frequently blurred, sometimes accidentally, and sometimes intentionally. Consider a software company that has been growing steadily for 10 years, that adds an AI-powered feature to its product, and then reports strong quarterly revenue. Is that AI revenue? Partially, perhaps, but you cannot simply take the entire revenue line and call it an AI story. The question is, how much of the growth is attributable to the AI feature versus how much would have occurred anyway because the underlying business is healthy? The cleanest examples of true AI revenue are found in companies that are selling AI capability directly. A company that sells access to a large language model through an application programming interface has AI revenue that is easy to trace. A company that sells AI-powered drug discovery services to pharmaceutical firms has AI revenue that can be measured. A company that charges for AI-generated software testing reports has AI revenue that is clear. But most companies are not in this position. Most companies are using AI internally, or embedding it in existing products, or deploying it to improve operational efficiency. In these cases, AI revenue is not a separate line item. It is distributed across the business in the form of cost savings, retention improvements, upsell opportunities, or productivity gains. Measuring it requires discipline and honest analysis. The questions you should ask are these. Has the company's revenue growth rate changed since it began deploying AI in a meaningful way? Has its gross margin improved in ways that suggest lower costs of delivery? Has its customer acquisition cost or retention rate shifted in ways that suggest AI is improving the product? Has its headcount growth slowed relative to revenue growth, suggesting that AI is improving productivity? These are the signs of real AI economic impact. They show up in the financial statements, and they are different from announcements. The anatomy of hype. Hype has a structure, and once you understand it, you will see it in every industry AI story. The first element of hype is the announcement cycle. A company announces that it is investing in AI, or partnering with an AI company, or launching an AI division, or hiring a chief AI officer. Each of these announcements generates media coverage and often a short-term stock price movement, but none of them, by themselves, create economic value. They create attention. The second element of hype is the demonstration. The company shows a prototype, a proof of concept, or an early version of an AI-powered product. The demonstration is impressive. The technology clearly works in controlled conditions. Investors who see the demonstration feel confident that the company is on the right path. But demonstrations are not products. Products must work at scale, in unpredictable real-world conditions, for customers who have not been coached on how to use them. The gap between a working demonstration and a commercially successful product is where a great many AI promises go to die. The third element of hype is the narrative leap. This is where analysts and investors begin to extrapolate from what exists to what could exist if everything goes right. A company has one AI product working reasonably well, and the narrative becomes, this company is positioned to transform its entire industry with AI. The extrapolation is often large, and the assumptions embedded in it are often optimistic. The fourth element is price appreciation, driven by the narrative rather than by fundamental change. The stock goes up because investors believe the story, and because the stock has gone up, the story seems validated, which attracts more investors, which pushes the price higher. This feedback loop can persist for quite a long time, but it is fragile because it is not anchored in reality. The moment the narrative encounters a serious challenge, whether a disappointing earnings report, a competitive threat, or simply the passage of time without results, the loop can reverse rapidly. The revenue test. The most reliable antidote to hype is a simple discipline. Before you invest based on an AI story, apply the revenue test. The revenue test asks 3 questions. First, is there actual revenue flowing from this company's AI capabilities today? Not promised revenue, not potential revenue. Revenue that appears in the company's financial statements and that can be attributed, even partially, to AI. Second, is that revenue growing at a rate that justifies the company's valuation? Many AI-associated companies are valued as if they will grow their revenue dramatically over the next several years. Sometimes this is justified. Often it assumes things that are uncertain, like sustained competitive advantage, successful customer adoption, and no significant disruption from new competitors. Third, what would the company be worth if AI did not work out as planned? This is the question investors rarely ask when enthusiasm is high, but it is the question that protects you from catastrophic loss. If a company's valuation is almost entirely dependent on AI delivering on its most optimistic projections, you are not just investing in a business. You are making a very specific bet about the future of a technology, and those bets have a less reliable track record than many investors like to believe. The difference between AI companies and companies with AI. There is an important distinction that deserves its own discussion, and it is the difference between companies that are fundamentally AI businesses and companies that are traditional businesses with AI capabilities added. This distinction matters because the two types of companies have very different risk profiles and very different potential for AI-specific value creation. A company that is fundamentally an AI business, a company whose entire product and business model depends on AI capability, has its future directly tied to the progress and adoption of AI. If AI continues to advance, and if the company's specific approach proves durable, the upside can be enormous. But the downside is equally significant. If a competitor produces a better model, or if the cost of AI capability drops to the point where the company's pricing power disappears, or if adoption is slower than projected, the entire thesis collapses. A traditional company with AI capabilities has a different profile. Its core business exists regardless of what happens with AI. The AI capabilities are additive. They improve the business, but they do not define its survival. This makes such a company less likely to produce extraordinary AI-driven returns, but also less likely to collapse under the weight of disappointed AI expectations. The best investments in the AI era are often found in a specific subset of the second category: traditional businesses with strong fundamentals, durable competitive positions, and AI capabilities that genuinely improve their economics in ways that the market has not fully priced in. These companies are less exciting than pure-play AI names. They attract less media coverage, they generate fewer breathless analyses, but they often represent better risk-adjusted value. Case thinking, the hype cycle in practice. To make this concrete, let us think through a hypothetical pattern that recurs across technology waves without naming specific companies. Picture a software company that has been operating profitably for 15 years, serving a specific industry with specialized tools. It announces that it is integrating a large language model into its core product, allowing users to interact with the software in natural language, to ask questions about their data, and to generate reports automatically. The market reacts enthusiastically. The stock rises substantially. Analysts upgrade their price targets. The company's management team speaks confidently about the AI opportunity. Now, apply the revenue test. Question 1. Is there AI revenue today? Perhaps a small amount. The company has launched an early version of the AI feature, and a modest number of customers have upgraded to access it, paying a higher subscription tier. This is real, but modest. Question 2. Is the growth rate justified by the valuation? Here, the math gets difficult. The company's stock has risen to reflect expectations of rapid AI-driven growth. For those expectations to be met, the AI feature must be adopted broadly by the existing customer base, must command a significant price premium, and must attract new customers who would not have chosen the product without it. Each of these assumptions is plausible, but none is certain, and the compounding of three uncertain assumptions is itself a significant risk. Question 3. What is the company worth without the AI story? If you strip out the AI-driven valuation premium and look at the underlying business, what do you find? If the core business is healthy and growing, the company has real underlying value that provides a floor. If the core business is flat or declining, and the AI story is the primary reason for the current valuation, you are in much more dangerous territory. This case-thinking exercise is not designed to make you pessimistic about AI. It is designed to make you precise. Precision is the quality that separates durable investors from trend chasers. The role of management. One factor that deserves particular attention in evaluating AI revenue versus AI hype is the quality of management communication. Companies with real AI results tend to talk about them in specific, measurable terms. They refer to cost savings per unit. They refer to revenue attributable to specific AI features. They refer to changes in customer retention or satisfaction that they can connect to AI improvements. They acknowledge what is working and what is not. They give you enough information to evaluate their progress rather than simply asking you to trust the vision. Companies that are primarily offering a hype narrative tend to speak differently. They use the language of transformation without showing you the transformation in the numbers. They reference AI partnerships without explaining the economics of those partnerships. They describe AI investments as strategic without quantifying the expected return. They promise future benefits without showing you the current trajectory. Learning to read earnings calls and investor presentations through this lens is a skill that takes practice, but it is one of the most valuable skills an AI-era investor can develop. The numbers tell the truth. The narratives tell the story management wants you to believe. Your job is to reconcile the two, and when they diverge significantly, to trust the numbers. Chapter 3. The AI Infrastructure Economy. There is a layer of the artificial intelligence economy that is easy to overlook because it sits beneath the applications that get all the attention. It is the infrastructure layer, and it is, in many ways, the most important place to understand if you want to invest intelligently in the AI era. When people talk about artificial intelligence as a transformation comparable to electricity, they are usually thinking about the applications, the things AI will do for us. But electricity did not just create useful appliances, it created an entire economy of infrastructure, power plants, transmission lines, industrial generators, electrical equipment manufacturers, companies that built the physical systems through which electricity flowed. These infrastructure businesses were, in many cases, better investments than the businesses that used electricity, precisely because they were necessary for every application, not just for the ones that succeeded. The same logic applies to artificial intelligence. Before AI does anything useful, it needs to run somewhere. It needs hardware to compute on. It needs memory to store information. It needs data centers to house that hardware. It needs networking to move data between components at extraordinary speeds. It needs cooling systems to prevent the hardware from overheating. It needs software to orchestrate all of these elements. And it needs enormous quantities of electricity to power everything. Every one of these requirements represents an economic opportunity, and every one of them is being pursued by companies that investors should understand. The scale of AI infrastructure demand. Let us start with scale, because the numbers involved in AI infrastructure are genuinely extraordinary, and understanding them helps you appreciate why infrastructure companies are experiencing the level of demand they are. Training a large AI model requires a quantity of computation that is difficult to describe in intuitive terms. Think of it this way: a simple calculation that your laptop might perform in a fraction of a second, multiplied by billions, and then multiplied by billions again, and then repeated across days or weeks of continuous processing. The largest AI models, currently being trained, require tens of thousands of specialized processor chips working simultaneously, consuming quantities of electricity that would serve a medium-sized town, housed in data centers that cost hundreds of millions of dollars to build. And training is just the beginning. Once a model is trained, deploying it for actual use, what is called inference in technical language, also requires substantial computing resources. When millions of people use an AI assistant simultaneously, each interaction requires computation. Scaling that to global demand requires infrastructure at a scale that simply did not exist a few years ago and must be built at extraordinary speed. This demand is not a short-term spike. It is a sustained, multi-year build-out that is being driven by competition among technology companies, by the need to serve a rapidly growing user base, and by the continued advancement of AI capabilities that require ever more powerful hardware. The investors who understood this dynamic early and who positioned in the companies building AI infrastructure have been among the major beneficiaries of the AI investment wave so far. The components of AI infrastructure. Let us break down the infrastructure layer into its key components, because each component has a distinct economic character and a distinct set of companies serving it. The first component is compute, the chips and processors that do the actual mathematical work of running AI models. This is the most dramatic and most discussed part of the infrastructure story, and it deserves its own chapter, which is Chapter 4. For now, the key point is that AI compute is highly specialized. The chips that run AI systems well are different in important ways from the chips that run conventional computing tasks, and only a handful of companies have the technological capability and the manufacturing infrastructure to produce them at scale. The second component is memory, the hardware that stores the vast amounts of data that AI systems need to access during computation. AI models require extremely fast memory access, and this has driven demand for specific types of memory chips that are more expensive and more technically demanding to produce than conventional computer memory. Companies that specialize in high bandwidth memory have found themselves in an enviable position as AI demand has accelerated. The third component is networking, the systems that allow information to flow between chips, between servers, and between data centers at the enormous speeds that AI workloads demand. As AI systems have grown larger and more complex, the demands on networking infrastructure have grown correspondingly. A training cluster that spans thousands of chips requires networking that can move data between those chips almost instantaneously, or the computation grinds to a halt, waiting for data to arrive. This has driven significant innovation and investment in high-speed networking technology. The fourth component is the physical data center itself. Buildings designed specifically to house AI hardware are different from conventional data centers. They require more power per square foot because AI hardware is denser and more power-hungry than conventional servers. They require more sophisticated cooling because the hardware generates more heat. They require specialized floor structures to support the weight of the equipment, and they must be built in locations with access to sufficient electrical power, which is itself becoming a constraint in some markets. The fifth component is power, and this is an area that many investors have only recently begun to appreciate. The electrical power required to run major AI infrastructure is enormous and growing rapidly. This is creating investment opportunities in power generation, power transmission, and energy storage that might not have seemed obviously connected to artificial intelligence until you think through the infrastructure chain. The infrastructure investment thesis. Why is infrastructure often a better investment entry point than application layer AI companies? The answer comes from economics. Infrastructure companies serve the entire AI economy, not just the applications that succeed. When someone builds a gold rush town, every merchant in that town profits from the rush of prospectors, regardless of which individual prospectors strike gold. The infrastructure is necessary for all of them. Application layer AI companies, by contrast, are competing with each other. Many of them will not survive. Many of the products they are building will be superseded by better products from other companies. The winners in the application layer will be enormously valuable, but picking those winners in advance is extraordinarily difficult. Infrastructure companies face competition too, and they face risks of their own. Technology can change in ways that make existing infrastructure less valuable. Customer concentration can be a risk if a small number of very large companies account for most of the demand. And the capital requirements for building AI infrastructure are enormous, which means that companies in this space must manage their finances carefully. But the fundamental logic of infrastructure investment remains attractive. The demand for AI compute, memory, networking, and power is visible, large, and growing. The companies with the technological capability and the manufacturing scale to serve that demand are in a genuinely strong position, and the barriers to entry are high enough that this position is likely to be durable for several years at a minimum. The build-out phase. One important nuance for infrastructure investors is understanding where we are in the build-out cycle. Build-out cycles follow a predictable pattern. In the early phase, demand surges ahead of supply, and infrastructure providers can name their price. Margins are exceptional. Revenue growth is extraordinary. Investors pour capital into the sector. In the middle phase, supply begins to catch up with demand, margins normalize, and growth rates slow from extraordinary to merely good. In the late phase, overcapacity can develop, prices fall, and weaker players are shaken out. AI infrastructure is currently in an early to middle phase of this cycle. Demand is strong, and supply is still catching up. But it is important to recognize that this situation will not persist indefinitely. The question for investors is not just whether infrastructure companies are doing well now, but how the economics will evolve as more capacity comes online and as the technology itself continues to change. The specific technology question that matters most for infrastructure investors is whether the current generation of AI hardware and data center design represents a durable standard, or whether it will be disrupted by fundamentally different approaches. If the next generation of AI models is substantially more efficient, requiring far less compute to achieve similar results, the build-out of current generation infrastructure may look less valuable in retrospect. This is not a reason to avoid infrastructure investment, but it is a reason to think carefully about which infrastructure players have the technological agility to adapt as the landscape evolves. Chapter 4: Chips and Compute. If there is a single company whose story captures the AI investment moment more vividly than any other, it is a semiconductor company. And the reason is straightforward. The mathematical work of artificial intelligence runs on silicon. It runs on chips. And the companies that design and manufacture those chips are at the very center of the economic value creation in the AI era. Understanding the chip industry, its economics, its competitive dynamics, and its risks is essential for any serious AI investor. Not because you must necessarily invest in chip companies, though some of them represent compelling opportunities, but because the chip industry is the most visible expression of the underlying economics of AI. It tells you what AI actually costs, what it requires, and who captures the value from those requirements. What AI chips are and why they are different. A computer chip is, at its most basic level, a device that performs mathematical calculations. The central processing unit, the chip that runs most conventional computing tasks, is designed to perform a wide variety of calculations very quickly, but only a few at a time. It is versatile and fast, like a very skilled generalist. The chip that powers artificial intelligence, most commonly a graphics processing unit or a tensor processing unit, works differently. It is designed not to perform one calculation very quickly, but to perform an enormous number of relatively simple calculations simultaneously. This parallel processing capability is what makes AI possible at practical scale, because training an AI model is essentially a matter of performing billions of similar mathematical operations simultaneously, and doing so repeatedly over days or weeks. The companies that design these AI-specific chips are doing something genuinely difficult: creating a chip that can perform parallel AI computations at maximum efficiency requires deep expertise in chip architecture, in the mathematics of machine learning, and in the manufacturing processes that translate chip designs into physical silicon. This expertise is rare, which is one reason why the AI chip market is highly concentrated. The manufacturing challenge. Understanding AI chips requires understanding something about how they are made, because the manufacturing process is itself a source of competitive advantage that is extraordinarily difficult to replicate. Modern chips are manufactured using a process that involves projecting patterns onto silicon wafers with extreme precision. The precision required is almost incomprehensibly fine. The features on the most advanced chips are measured in nanometers, which are billionths of a meter, smaller than the wavelength of visible light. Achieving this level of precision requires machines that are among the most complex and expensive ever built. The manufacture of these machines is itself a concentrated industry, with one Dutch company holding a near monopoly on the production of the lithography systems required for the most advanced chip manufacturing. The chips are then fabricated by a very small number of specialized foundries, with one Taiwanese company holding a dominant position in advanced chip fabrication. This supply chain means that the chip industry has choke points, concentrated points of control, where a small number of entities have enormous power over global production. These choke points are simultaneously a source of competitive advantage for the dominant players and a source of geopolitical risk for the entire AI economy, a topic we will return to later in this chapter. The economics of AI chips. The economics of AI chips are, from an investor's perspective, fascinating and unusual. Demand for AI chips has grown so fast that it has significantly outpaced supply. This is a classic economic situation where suppliers have pricing power, which means they can charge more without losing customers, because customers have no alternative source for what they need. When a technology company wants to train a large AI model, it needs chips. There are only a few places where it can get the chips that will actually work for this purpose. So it pays what the supplier asks. This pricing power has translated into exceptional financial performance for the dominant AI chip designers. Revenue has grown dramatically. Gross margins, which measure how much of each revenue dollar the company keeps after paying the direct costs of making the product, have risen to levels that would be extraordinary in almost any other industry. But pricing power depends on the supply-demand balance remaining favorable. As more chip manufacturing capacity comes online, and as alternative chip designs emerge, the balance will shift. This is not a reason for immediate concern, because building chip manufacturing capacity takes years and enormous capital investment. But it is a reason to think carefully about what current chip company valuations are assuming about the durability of that pricing power. The competition. The competition in AI chips is heating up from two directions. The first direction is traditional competitors, other chip companies that are working hard to develop products that can compete with the current market leaders. Competition of this kind is a normal part of any technology market. The leading chip designers have significant advantages in performance and in the software ecosystems built around their products, which makes it difficult for challengers to gain traction quickly. But technology markets have a way of surprising established leaders, and the incentive to compete is enormous given the size of the opportunity. The second direction is more unusual. The largest customers of AI chips, the technology companies that buy chips by the tens of thousands to run their AI systems, have begun designing their own chips internally. This is a rational response to their situation. If you are spending billions of dollars on a single type of component, designing that component yourself can be economically attractive, even if the chip design effort is expensive, because it allows you to optimize for your specific workload, to reduce costs, and to reduce dependence on external suppliers. This trend of large technology companies designing their own AI chips is a meaningful long-term challenge for dedicated chip companies. It will not happen quickly, and internal chips are unlikely to fully replace external purchases for most applications. But it does mean that the addressable market for commercial AI chips may be somewhat smaller in the future than it appears today, because some of the largest potential buyers will be partially supplying themselves. Geopolitical dimensions. No discussion of AI chips is complete without addressing the geopolitical dimension, which has become a significant factor in chip investment analysis. The geography of semiconductor manufacturing is highly concentrated. Advanced chip design is concentrated in a small number of companies, primarily in the United States. Advanced chip fabrication is concentrated in Taiwan, with meaningful capacity in South Korea. The machines required for advanced chip manufacturing are concentrated in the Netherlands and Japan. This concentration means that the AI chip supply chain runs through a small number of countries and companies, and governments around the world have become acutely aware of this. The United States government has imposed restrictions on the export of advanced AI chips and chip manufacturing equipment to certain countries, particularly China, in response to concerns about AI being used to enhance military capabilities. These restrictions have several effects on the investment landscape. They reduce the addressable market for AI chip companies in the near term, since they cannot sell freely to all potential customers. They accelerate the push by restricted countries to develop domestic chip manufacturing capabilities, which could eventually create new competition. And they create ongoing uncertainty about the rules of the market, which is itself a risk factor for investors. At the same time, the restrictions have created urgency among Western governments to invest in domestic chip manufacturing capability, which has led to substantial subsidies for new semiconductor facilities. These subsidies benefit companies building new fabs in the United States and Europe, and they represent a meaningful change in the policy environment for chip makers. The long-term view. Stepping back from the near-term dynamics, what does the long-term investment landscape look like for AI chips? The fundamental driver is clear and unlikely to disappear. AI will continue to advance, and advancing AI will require more and more compute. Every major technology company in the world is investing heavily in AI, and they all need chips to run it. The demand trajectory is, on balance, a favorable one for chip companies. The uncertainty is about who captures the value of that demand over time. Will the current dominant players maintain their position? Will alternative chip architectures emerge that disrupt the current hierarchy? Will the push toward custom chip design by large technology companies significantly reduce demand for commercial chips? Will manufacturing capacity constraints ease in ways that reduce pricing power? These questions do not have certain answers. What they point to is the need for ongoing analysis rather than a set-it-and-forget-it investment posture in the chip sector. The companies that are well-positioned today may not be equally well-positioned in 5 years, and staying informed about the technological and competitive dynamics is essential. What is certain is that chips are the foundation of the AI economy, and the companies that design, manufacture, and supply them are participating in one of the most significant technological investment cycles of our lifetimes. Chapter 5: Cloud and Data Centers. If chips are the engines of artificial intelligence, then data centers are the buildings that house those engines, and cloud computing platforms are the services that make those buildings accessible to the rest of the world. Understanding the relationship between AI and cloud computing is essential for investors, because the cloud companies are among the most consequential participants in the AI economy, and their position in that economy is more nuanced than it might initially appear. What cloud computing actually is. Cloud computing is, at its most basic level, the practice of accessing computing resources, processing power, memory, storage, and software over the internet rather than owning and managing those resources yourself. Before cloud computing became widely available, a company that wanted to run computing workloads had to buy its own servers, set them up in its own data centers, hire its own technical staff to manage them, and deal with all the complexity and expense that this entailed. This was feasible for large companies with substantial IT budgets, but it was a significant barrier for smaller organizations, and even large companies struggled with the inefficiency of having computing capacity sitting idle much of the time. Cloud computing solved these problems by allowing companies to rent computing capacity on demand, paying only for what they use, and scaling up or down as their needs change. The companies providing this service built enormous data centers housing hundreds of thousands of servers, achieved tremendous economies of scale, and offered their customers the ability to access world-class computing infrastructure without building it themselves. The 3 largest cloud providers today operate at a scale that is genuinely staggering. Their data centers span the globe. Their infrastructure represents capital investment measured in the hundreds of billions of dollars. And they are expanding that infrastructure as fast as they can, driven largely by the demand for AI computing. Why AI is a cloud business. The relationship between AI and cloud computing is, at first glance, straightforward. AI requires enormous computing resources. Cloud companies offer computing resources at scale. Therefore, cloud companies benefit from AI demand. This is true, but the reality is more complex and more interesting. The most important nuance is that not all AI computing happens in the cloud. The major technology companies that are the most intensive AI users, companies like the providers of the largest AI models, often own their own data center infrastructure rather than renting it from cloud providers. When you use an AI assistant, Provided by a large technology company, the computation powering that experience is likely running in data centers owned and operated by that company, not rented from a cloud provider. Cloud providers benefit most from the enterprises and smaller technology companies that are adopting AI. A pharmaceutical company that wants to use AI for drug discovery, a financial services firm that wants to deploy AI for risk analysis, a retailer that wants to use AI for demand forecasting. These organizations are much more likely to build their AI capabilities on cloud infrastructure than to build their own data centers. The cost and complexity of building private AI infrastructure is prohibitive for all but the very largest technology firms. This creates a large and growing market for cloud providers in the enterprise AI segment. But it also means that the growth of cloud AI revenue is tied to the pace of enterprise AI adoption, which is somewhat slower and more uncertain than the pace of adoption among large technology companies, which already have their own infrastructure. The data center economy. Data centers are not just a feature of cloud computing. They have become an economy unto themselves, and understanding this economy reveals important investment opportunities that are not obvious from the names of the largest cloud companies. A large modern data center is a complex and expensive piece of infrastructure. The building itself must be engineered to precise specifications. The power systems must be redundant and reliable, because even a brief power outage in a data center serving AI workloads can be enormously disruptive. The cooling systems must be capable of removing heat from equipment that generates it at very high densities. The networking must be capable of moving data at extraordinary speeds, and all of this must be managed and maintained by specialized technical staff. The companies that build, own, and operate data centers on behalf of cloud providers and other large technology companies are called data center real estate investment trusts, or data center operators. Some of them are structured as real estate investment trusts, which is a financial structure that carries specific tax advantages and dividend requirements. Others are structured as traditional corporations. Either way, they have found themselves in a position of strong and growing demand as the AI build-out accelerates. The economics of data center operation are different from the economics of technology companies. Data centers are capital-intensive, meaning they require large upfront investments in buildings and equipment. But they also generate stable, long-term revenue streams because the customers that install equipment in a data center, whether that is a cloud provider or a large enterprise, typically sign multi-year contracts and are unlikely to move frequently because moving is expensive and disruptive. This combination of characteristics, stable revenue, long-term contracts, and growing demand makes data center operators attractive to investors who want exposure to the AI infrastructure build-out without taking on the technology risk of betting on specific AI applications. Power as a bottleneck. One of the most important and underappreciated dimensions of the AI data center story is the power constraint. AI computing hardware consumes enormous quantities of electricity. A single rack of AI servers, which is a standard unit of data center organization, can consume many times the power of a conventional computing rack. As AI workloads have grown, the power density of data centers has increased dramatically, and this is creating challenges that the industry is working hard to solve. The fundamental problem is that in many markets, the electrical grid cannot easily supply the power that a large AI data center requires. Utilities have finite capacity, and building new power generation and transmission infrastructure takes years. This means that the availability of land near sufficient electrical capacity has become a significant constraint on data center development. The response to this constraint is taking several forms. Data center operators are investing in their own power generation, including solar, wind, and even nuclear. They are working with utilities to secure long-term power agreements. They are looking at locations with unusual access to cheap and abundant power, including areas near large hydroelectric facilities or regions with abundant renewable energy resources. For investors, the power constraint creates opportunities in several adjacent sectors. Companies that generate electricity and can serve AI data centers are seeing strong demand. Companies that manufacture electrical infrastructure equipment, transformers, switchgear, power distribution systems, are seeing their products in short supply because the build-out of data center power systems is happening faster than the supply chain can comfortably absorb. Companies that can provide cooling solutions are in a similar position. As AI hardware has become denser and more power-hungry, conventional cooling approaches have become inadequate, and a new generation of cooling technology, including liquid cooling systems that circulate coolant directly through computer hardware, has become a significant and growing market. The long, competitive dynamic. A question that deserves attention for anyone investing in cloud companies specifically is the competitive dynamic among the major cloud providers. The three largest cloud providers have significant competitive advantages. They have massive existing customer relationships. They have the infrastructure and the technical expertise to serve complex enterprise needs. They have established software ecosystems built around their platforms, including AI development tools, machine learning platforms, and data analytics services. But they also face competition from each other, which is intense, and competition from specialized AI platforms that offer specific AI capabilities without requiring customers to commit to a full cloud ecosystem. As AI capabilities have proliferated, the market for AI cloud services has become more complex, with enterprises often using multiple providers for different workloads. The implication for investors is that the largest cloud providers are not all equal in their AI positioning. Some have made deeper investments in AI infrastructure and AI services. Some have stronger relationships with the developers building AI applications. Analyzing these differences requires looking at more than just total cloud revenue. It requires understanding which parts of the AI cloud market each provider is winning and losing. Chapter 6. Software Disruption. Of all the industries being transformed by artificial intelligence, software is perhaps the most important to understand, because software is not just a sector of the economy, it is the medium through which almost every other AI application reaches the world. And it is also, paradoxically, one of the industries most deeply disrupted by AI. This paradox is worth sitting with for a moment. AI runs on software. AI is developed using software. AI is delivered through software. And yet AI is simultaneously threatening the business models of many software companies, changing the economics of software development in fundamental ways, and forcing every software company to rethink its competitive position. Understanding this paradox is essential for investors because the software sector contains some of the most significant AI winners and some of the most significant AI casualties, often right next to each other. How software works as a business. To understand how AI is disrupting software, you need to first understand what made the software business so attractive in the first place. Software has historically been a remarkable business for one central reason. The cost of producing the first copy of a piece of software is high. It requires skilled engineers working for months or years. But the cost of producing every additional copy is essentially zero. A piece of software can be sold to 1 million customers at the same cost as it is sold to one, because distributing software over the internet is essentially free. This characteristic, what economists call high fixed costs and near zero marginal costs, creates the potential for extraordinary profitability once a software product reaches scale. A software company that has invested heavily to build a great product and that has succeeded in acquiring a large customer base can be enormously profitable because each additional customer adds almost pure profit. The subscription software model, which became dominant over the past decade, amplified this further. Instead of customers paying once and owning a product forever. They pay monthly or annually for continued access. This creates a recurring revenue stream that is predictable and, in companies with loyal customer bases and low churn, highly valuable. The competitive dynamics in software are also favorable for incumbents. Once a business has adopted a software system, the cost of switching to an alternative, including the cost of retraining employees, migrating data, and disrupting workflows, is often high enough to create significant customer stickiness even when competing products exist. How AI changes software economics. Now consider how artificial intelligence disrupts these economics. The first and most dramatic disruption is in software development itself. Writing software has always required skilled engineers, and skilled engineers are expensive. The cost of building a new software product has always been a significant barrier to entry that protected incumbent software companies from competition. AI coding tools are changing this in a fundamental way. Modern AI systems can write code, debug code, and design software systems in ways that allow smaller teams to build more complex products in less time. This is not a distant future possibility. It is happening now, and the effect on software development productivity is real and measurable. What does this mean for software companies? It means two things simultaneously. It means that established software companies can potentially become more efficient, building new features and maintaining existing products with smaller engineering teams. And it means that barriers to entry in software are declining because the cost of building a competing product has fallen. The second disruption is more subtle but equally important. AI is creating a new category of software capability, the ability to perform tasks that previously required human judgment. Writing, analysis, research, coding, design, customer service. These are all tasks that software could not historically perform well, and that therefore required human employees. AI is now capable of performing all of them to a useful standard, and in many cases, to a standard that meets or exceeds what a human employee could achieve. For software companies that have built their products around facilitating human work, this creates both an opportunity and a threat. The opportunity is that they can embed AI capabilities into their products and make them far more valuable. The threat is that if the AI capability becomes good enough to perform the underlying task directly, the software that was previously used to manage the humans doing the task may become unnecessary. The consolidation risk. One of the most significant risks for software companies in the AI era is consolidation, the tendency for AI to allow a smaller number of very powerful products to serve needs that previously required many specialized tools. Here is the mechanism. Before AI, software tended to be specialized. You used a particular tool for writing, a different tool for analysis, a different tool for customer communication, a different tool for project management. Each of these tools was optimized for its specific purpose, and this specialization created opportunities for many software companies to occupy specific niches. AI changes this because an AI system is, by nature, a general-purpose capability. A sufficiently capable AI assistant can write, analyze, communicate, and manage projects, all within a single interface. The need for multiple specialized tools may diminish as AI capabilities improve because a single AI-powered platform may be able to serve multiple needs that previously required multiple software products. This is a genuine threat to the long tail of specialized software companies, the businesses that have built strong niche positions by serving specific workflow needs for specific types of organizations. If a general AI platform can serve the same need adequately, the value proposition of the specialist diminishes. The counter-argument is that specialization will always be valued in some contexts, that the specific domain knowledge embedded in specialized software tools is not easily replicated by general AI. and that the switching costs of abandoning established software systems are high enough to protect incumbents even when alternative products exist. Both arguments have merit, and the outcome will likely vary by specific software category and by the quality of the AI capabilities being developed in each space. This makes the software sector one of the most analytically demanding areas of AI investment, requiring detailed, category-by-category analysis rather than sweeping generalizations. The opportunity side. It would be incomplete to focus only on the disruption risk in software without acknowledging the significant opportunity. Software companies that successfully embed AI into their products are creating genuinely better products that are harder to compete with. A software platform that can analyze your data, write reports, answer questions, and automate workflows is more valuable than one that simply stores and displays information. And companies that were already in strong competitive positions, with large customer bases, proprietary data, and high switching costs, are in the best position to use AI to widen their moats rather than watch those moats be eroded. The companies most likely to benefit from AI in the software sector are those with large proprietary datasets that can be used to train or fine-tune AI models, those with distribution advantages that allow them to reach large customer bases quickly with new AI features, and those with platform positions that allow them to capture value from the AI capabilities they add without facing immediate competition from alternatives. Chapter 7: AI and Labor Costs. One of the most important and most underappreciated dimensions of the AI investment story is its relationship to labor costs. This might seem like a simple topic. AI automates tasks. Automation reduces the need for human labor. Companies that adopt AI have lower labor costs. Lower labor costs mean higher profit margins. But the reality is considerably more complex, and understanding the full picture is essential for evaluating both the companies that benefit from AI's impact on labor and the companies that are most vulnerable to it. The labor cost structure of different industries. Different industries have very different relationships to labor as a component of their cost structure. For industries where labor is the primary cost, the potential for AI to reduce that cost is enormous and potentially transformative. Consider an industry where 70 or 80 cents of every revenue dollar goes to paying employees. If AI allows that company to deliver the same output with 50 cents of labor per revenue dollar, the margin improvement is dramatic, even if everything else stays the same. For industries where labor is a smaller component of costs, the direct labor cost savings from AI are proportionally smaller. But even here, AI can create value by allowing the same workforce to produce more output, which effectively raises revenue per employee rather than reducing headcount. The investor should always ask, for the company they are evaluating, what is the labor intensity of the business, and what specific tasks does AI have the most potential to replace or augment? Tasks versus jobs. Here is a crucial distinction that shapes how AI affects labor markets and company economics. AI does not replace jobs. AI replaces tasks, and the difference matters enormously. Every job is a bundle of tasks, some of which are highly routine and repetitive, some of which require creativity and judgment, some of which require physical presence or physical dexterity, and some of which require human relationships and trust. AI is very good at some of these tasks. It is excellent at processing large amounts of information quickly. It is excellent at pattern recognition. It is excellent at generating text, images, code, and other content according to specified parameters. It is improving rapidly at tasks that require reasoning and analysis. AI is much less good at other tasks. It cannot yet reliably perform complex physical tasks in unstructured environments. It lacks the genuine empathy and social intelligence that human relationships require. It cannot yet consistently exercise the kind of contextual judgment that experienced human professionals apply in novel situations. So when AI affects a company's labor costs, what typically happens is that the tasks AI can perform are taken over by AI, while human employees shift their focus to the tasks that AI cannot yet do well. This means that the number of employees may not change dramatically, but the type of work they do changes significantly. Some employees who are performing AI replaceable tasks may find that their roles diminish or disappear. Others may find that their productivity increases dramatically because AI handles the routine parts of their work and they can focus on higher value activities. The productivity paradox. There is a counterintuitive dimension to AI's impact on labor costs that investors need to understand, sometimes called the productivity paradox. When a new technology makes workers more productive, the expected result is that companies need fewer workers. But historically, productivity-enhancing technologies have often led to more employment, not less, over the medium to long term. The mechanism is this. When companies become more productive and their costs fall, they can offer their products or services at lower prices or with higher quality. Lower prices or higher quality attract more customers. More customers mean more revenue. More revenue means more work. And more work means more employees. Whether this mechanism fully operates in the AI era is uncertain. The pace of AI productivity enhancement may be faster than the pace at which new demand can absorb the freed-up labor capacity. The types of tasks that AI handles well may be concentrated in specific industries, creating labor displacement that is geographically and demographically uneven in ways that the simple aggregate analysis misses. But for investors evaluating specific companies, the productivity paradox suggests that the most straightforward version of the AI labor cost story, fewer employees means lower costs and higher profits, may be too simple. A company that uses AI to become dramatically more productive may choose to reinvest that productivity in growth rather than margin improvement. The way a company deploys its AI-driven productivity gains tells you a great deal about its strategic priorities and the quality of its management. Where the labor savings are real and large. Setting aside the complexity, there are specific areas where AI's impact on labor costs is likely to be large, real, and relatively near-term. Customer service is perhaps the clearest example. A large fraction of customer service interactions involve predictable questions and straightforward processes, and AI is now capable of handling these interactions to a quality standard that customers find acceptable. Companies that have invested in AI-powered customer service tools are seeing real reductions in the cost of handling customer inquiries. Document processing is another clear area. Industries that handle large volumes of documents, whether those are insurance claims, loan applications, legal contracts, medical records, or financial reports, spend enormous amounts of money on employees who read, categorize, extract information from, and route those documents. AI can perform many of these tasks faster, more accurately, and at a fraction of the cost. Content generation is a third area. Marketing departments, media companies, communications teams, and other organizations that produce large volumes of written content are finding that AI can produce usable first drafts, generate variations for testing, and assist writers in ways that significantly increase output per writer. Code generation and software testing, as discussed in the previous chapter, represent a fourth area where AI is having a measurable impact on labor requirements. The companies that operate in these areas and that are successfully deploying AI for these tasks are the ones where you can most clearly trace AI's impact on the financial statements. And when you can trace it clearly, you can value it with greater confidence. Chapter 8. Companies at risk of AI disruption. Every investment story has two sides: the companies that gain from a transformation and the companies that lose. So far, this book has focused primarily on the gaining side, but understanding the risks is just as important, both for avoiding bad investments and for identifying short-selling opportunities or underweight positions in portfolios. This chapter is about the companies and business models that are genuinely at risk from artificial intelligence, not because they are doing anything wrong, but because the economics of their industry are being fundamentally challenged by a technology they did not create and cannot easily control. The pattern of disruption. Disruption follows a pattern that is worth understanding clearly because it affects how visible the risk is at any given moment. The pattern begins with AI achieving a capability that was previously exclusive to humans. This capability is often imperfect at first, and the incumbents whose business depends on human capability tend to dismiss it or point out its limitations. This dismissal is often correct in the short term. Early AI capabilities genuinely are limited and imperfect, but AI capabilities improve rapidly, faster than most incumbents expect. And there is a threshold effect where an AI capability that is 70% as good as a human expert is interesting but not commercially threatening, while a capability that is 90% as good at 1/10 the cost is devastating. The businesses that are most at risk are the ones whose value proposition is explicitly or primarily based on the human capability that AI is approaching. If your competitive advantage is that your people are better than your competitors' people at a specific cognitive task, and AI can perform that task adequately or better, your competitive advantage is disappearing, even if it does not feel that way yet. Industries facing structural challenges. Let us examine specific industries and sectors where this pattern is most clearly playing out. The first is certain segments of professional services. Some of the work, performed by junior employees in law firms, consulting firms, and accounting firms, involves tasks that AI can increasingly perform. Legal research, contract review, financial analysis, market research, report generation. These tasks have historically been performed by highly paid professionals, generating substantial revenue for their employers. As AI takes over more of this work, the business models of firms that depend on billing for these hours face fundamental pressure. The most vulnerable are the firms at the lower end of the value chain, those competing primarily on price and volume for relatively standardized professional services. The firms at the top, those competing on rare expertise, deep relationships, and complex judgment, are less immediately threatened, though even they will face changing economics as AI handles more of the routine work that currently fills junior positions. The second area is certain media and content businesses. The economics of producing written content, images, audio, and even video are changing rapidly as AI makes content generation faster and cheaper. This affects businesses that compete primarily on content volume, that produce large amounts of relatively standardized content. News aggregators, content marketing companies, stock photography businesses, and similar organizations are already feeling the pressure. Premium content businesses, those that compete on depth of reporting, quality of journalism, distinctive creative voice, or exclusive access, are in a stronger position because their value proposition is based on things AI cannot yet replicate. But even they will need to think carefully about how AI changes the economics of their industry and the expectations of their audiences. The third area is certain educational technology companies. AI tutoring systems are becoming increasingly capable of providing personalized learning experiences that rival or exceed what standardized educational software can offer. Companies that have built businesses on curriculum delivery and assessment tools face competition from AI systems that can adapt more dynamically to individual learners. The fourth area is certain categories of outsourcing and business process services. Companies that have built businesses on the proposition of performing business processes more cheaply by using lower-cost labor, whether that labor is in their own country or offshore, face a fundamental challenge when AI can perform those same processes more cheaply still, without the organizational complexity of managing a large workforce. The fifth area is translation and localization services. AI translation has improved dramatically and is now capable of producing output of sufficient quality for many commercial purposes. The businesses built on providing human translation services for large volumes of relatively routine content are facing real and growing pressure. How to spot disruption risk. Recognizing disruption risk in a specific company requires asking a specific set of questions. First, what is the core value proposition of this company, and what fraction of that value proposition depends on humans performing cognitive tasks that AI can now perform or is approaching the ability to perform? Second, has the company's management team acknowledged the AI challenge, and do they have a credible response? A management team that dismisses the risk entirely is more dangerous than one that acknowledges it and articulates a plan, even an uncertain one. Third, is there evidence in the financial statements of AI-driven pressure? Are margins beginning to compress? Is revenue growth slowing in ways that were not true a few years ago? Are customers defecting to AI-native alternatives? Fourth, what is the switching cost structure of the business? Companies with high switching costs, where customers are deeply embedded in systems and processes that are expensive to change, have more time to adapt than companies where switching is easy. Fifth, what is the company's balance sheet? A company facing AI disruption with a strong balance sheet and low debt has more options, more time to adapt, to acquire AI capabilities, to pivot the business model than a company that is financially stressed. The most dangerous position. The most dangerous position for an investor is holding a company that is facing AI disruption, but whose stock price does not yet reflect that risk. This happens when the company's current financial results still look reasonable, because disruption is often slow to show up in the numbers until it is very advanced, and when the market is not yet focused on the structural challenge. The way to identify this position is to combine fundamental analysis with strategic analysis. Look past the current numbers to the underlying business model. Ask whether the value proposition that has historically driven the company's success is durable in an AI world. If the answer is no, or even a conditional no, that is information that the current stock price may not yet reflect. Chapter 9. Detecting AI bubbles. History suggests that every transformative technology produces a bubble, a period during which market valuations for technology-related assets significantly exceed what fundamental economics can justify. The railroads produced one. Radio produced one. The internet produced a famous one. And there is a meaningful possibility that artificial intelligence will produce one too, if it has not already. This does not mean AI itself is a bubble. The technology is real. The economic impact is real. The value being created is real. Bubbles occur not because the underlying technology is fraudulent, but because the market overestimates how quickly and evenly the value will distribute, overestimates how many companies will benefit, and underestimates how many will be disrupted or displaced. The anatomy of a technology bubble. A technology bubble has a recognizable anatomy. It begins with a genuine insight. A technology arrives that is clearly powerful and that will clearly change things. This insight is correct. The investors who act on it early are right to do so. But the insight spreads, and as it spreads, it attracts capital that is less discriminating. Early investors had to do careful analysis to identify which companies would benefit. Later, investors simply need to know that AI is important, and they buy anything associated with it. This undiscriminating capital pushes prices higher for the entire sector, including companies that are not genuinely benefiting and companies that are being disrupted. At the same time, companies begin to consciously associate themselves with the narrative. They change their names to include AI-related terms. They announce AI initiatives. They hire people with AI credentials and put them in prominent roles. The association with AI becomes a source of stock price support, regardless of whether the underlying business is actually changing in meaningful ways. The bubble enters a danger zone when valuations require not just good outcomes, but perfect outcomes. When a company's stock price can only be justified by assuming that it will capture a dominant share of an enormous market, that it will face no serious competition, that it will execute flawlessly for the next decade, you are in bubble territory. The bubble eventually deflates, not necessarily in a dramatic crash, sometimes in a slow, grinding correction that takes years, when the distance between what price is assumed and what reality delivered becomes too large to ignore. Warning signs. What are the specific warning signs that AI valuations are reaching bubble territory? The first warning sign is valuation multiples that cannot be justified by any realistic scenario analysis. When you model out a company's future revenues, costs, and profits under optimistic, base, and pessimistic scenarios, and the current stock price is higher than even your optimistic scenario, something has gone wrong. The price is not reflecting analysis. It is reflecting emotion. The second warning sign is the spread of the AI narrative to companies with very weak actual AI connections. When companies in mature, slow-growing industries see their valuations rise simply because they have mentioned AI in their investor communications, without showing any evidence of AI-driven improvement in their economics, the narrative has spread beyond what the underlying reality can support. The third warning sign is a significant increase in the number of new companies coming to market with AI-related business models and rich valuations, particularly when those companies have limited revenue or unprofitable operations. The number of IPOs and special purpose acquisition companies, or SPACs, focused on AI opportunities is a useful indicator of market enthusiasm, and historically, peaks in IPO activity in a particular sector have corresponded with peaks in sector valuations. The fourth warning sign is when AI investments start generating capital losses rather than capital gains for the early stages of what was a strong investment, not just in individual companies, but across a broad range of AI-related names. This is the market beginning to reprice from narrative back toward fundamentals. The fifth warning sign is insider selling at elevated rates. When the founders, executives, and venture investors in AI companies are selling their shares at an accelerating pace, they are telling you something about how they view the relationship between current prices and long-term value. Bubbles and opportunity. Here is a nuance that is often missed in discussions of technology bubbles. Bubbles and genuine investment opportunity coexist. In the internet bubble, many company valuations were wildly excessive, but the internet itself was not a fraud. The long-term winners from the internet era, the companies that survived the crash and rebuilt on solid foundations, went on to become among the most valuable businesses in history. Investors who bought at the peak of the bubble in 2000 generally did poorly, but investors who bought in 2002 and 2003, after the bubble had deflated, did extraordinarily well. The lesson is not to avoid AI investment. The lesson is to buy carefully, with reference to price, and to recognize that the most enthusiasm-driven part of a technology cycle is not necessarily the best time to buy. The corollary lesson is that bubbles often overshoot in both directions. They overprice in the boom and underprice in the bust. The companies that have real, durable AI advantages will often be better values after the inevitable correction than they are today. Distinguishing bubble from genuine value. How do you distinguish between an AI valuation that reflects genuine long-term value and one that reflects bubble dynamics? The test involves asking several questions simultaneously. Does the company have revenue that is demonstrably linked to AI? Not potential future revenue. Not revenue from customers who have signed letters of intent. Actual revenue that shows up in the financial statements and is growing? Does the company have a path to profitability that does not require heroic assumptions? Many technology companies operate at a loss while investing in growth, and this is not inherently problematic. But the path to profitability should be visible and should not depend on the AI market growing at triple-digit rates indefinitely. Does the company have a genuine competitive advantage that is durable? Is there something about this company's position in the AI economy that is difficult for competitors to replicate? And finally, does the current valuation leave room for error? Even if everything goes roughly right for this company, does the stock offer a reasonable return from the current price? Or is the stock already priced for perfection? A company that passes all four of these tests is probably not in bubble territory, even if AI valuations broadly are elevated. A company that fails one or more of them deserves more scrutiny before you commit capital. Chapter 10. Valuing AI Growth. We have now covered the landscape of AI investment opportunity and risk in some depth. It is time to get into the mechanics of how to actually value companies in this environment, because valuation is where the abstract analysis of opportunity and risk becomes a concrete judgment about price. Valuation is perhaps the most technically demanding topic in this book, but it is also the most important. A great company at the wrong price is a bad investment. A mediocre company at the right price can be a good one. Understanding valuation well is what allows you to act on your analysis rather than simply being informed by it. The challenge of valuing AI companies. Valuing AI companies is genuinely difficult, and it is worth being honest about why. The traditional approach to valuing a business is to estimate its future cash flows and to discount those future cash flows back to the present at a rate that reflects the risk of achieving them. This approach works well when you have a clear picture of a company's earnings trajectory and a reasonable estimate of how that trajectory will evolve over time. For many AI companies, neither of these conditions holds. The earnings trajectory is uncertain because the market is new, the competition is intense and evolving, and the technology itself is changing fast. The discount rate is difficult to estimate because the risk profile of a company building AI capabilities is genuinely different from the risk profile of a mature business, and standard frameworks for thinking about risk may not capture the specific ways that AI companies can fail or succeed. Despite these challenges, the fundamental logic of valuation does not change. You are trying to pay less for a company today than the discounted value of the cash flows it will generate in the future. The difficulty is in estimating those cash flows and the appropriate discount rate, not in the conceptual framework itself. Multiple frameworks. Rather than relying on a single valuation approach, thoughtful AI investors use multiple frameworks and ask whether they point in the same direction. The first framework is revenue multiple analysis. For companies that are growing fast but not yet profitable, investors often look at the ratio of market capitalization to revenue. This approach is imprecise, but it provides a rough sense of how much the market is paying per dollar of current revenue, and it allows for comparison across similar companies. The limitation of this approach is that revenue multiples vary enormously based on growth rate, margin structure, and the quality of the revenue, and a simple multiple without context can be very misleading. The second framework is scenario analysis. Rather than projecting a single future for the company, you build out multiple scenarios, an optimistic case, a base case, and a pessimistic case, and you estimate the company's value in each scenario. Then, you weight those scenarios by their probability and compare the probability-weighted value to the current stock price. If the current price significantly exceeds even your optimistic case, the stock is expensive. If the current price is below your base case value, the stock may be attractive. The third framework is comparable company analysis, sometimes called comps. You look at the valuation multiples of companies with similar business models, growth rates, and competitive positions, and you ask whether the company you are evaluating is cheap or expensive relative to its peers. This approach is useful for identifying relative value, even when the absolute value of the entire sector is uncertain. The fourth framework is sum of the parts analysis. For large, diversified companies with both AI and non-AI businesses, it can be useful to value each business separately and then add them up. This reveals whether the market is attributing significant value to the AI business or whether the AI opportunity is essentially being offered for free if you are willing to buy the non-AI business at a fair price. The role of growth. Growth is the central variable in AI company valuation, and getting it right matters enormously. The relationship between growth and value is not linear. A company growing at 40% per year is not simply twice as valuable as a company growing at 20% per year. Because growth compounds, a company that can sustain higher growth rates for longer is worth dramatically more. A company that grows at 40% for 10 years will be roughly 15 times larger than a company that grows at 20% for the same period. This compounding effect means that small differences in long-run growth assumptions produce large differences in estimated value. For AI companies, the critical question is how long the elevated growth rate is sustainable. A company that benefits from being early to market with an AI capability may enjoy strong growth for several years while its competitors catch up. But once competitors offer similar capabilities, growth rates typically normalize. And if the stock was priced for sustained high growth, that normalization is painful. The most important question to ask when evaluating an AI company's growth trajectory is, what is the source of the growth? And is that source durable? If a company is growing because it has a genuinely superior product with no close competitor, and if building a competitive alternative is difficult and time-consuming, the growth may be sustainable for longer than the market expects. If a company is growing because it was first to market with an AI feature that competitors are already replicating, the growth is much less durable. The discount rate question. The discount rate you apply to a company's projected future cash flows has an enormous impact on the resulting valuation, and this is a dimension of AI valuation that deserves explicit attention. The discount rate represents the return you require to compensate you for the risk of investing in this company. A higher discount rate means you require more future cash flows to justify a given current price, which produces a lower current valuation. A lower discount rate produces a higher valuation. For AI companies, the appropriate discount rate is genuinely uncertain. These companies often operate in new markets with uncertain competitive dynamics, uncertain regulatory environments, and uncertain technological futures. This uncertainty argues for higher discount rates, which would produce lower valuations than the market sometimes applies. But AI companies also often have characteristics that reduce some risks. The largest and most well-capitalized AI companies have access to capital that allows them to sustain losses during a growth phase, to acquire competitors, and to invest in research and development at a level that smaller challengers cannot match. This scale advantage reduces some of the existential risk that would otherwise warrant very high discount rates. The practical implication is that when you are evaluating an AI company, you should ask what discount rate is implied by the current stock price given your projections for future cash flows, and whether that discount rate seems appropriate for the risk profile of the business. If the implied discount rate is very low, the stock is priced for a very optimistic view of both future growth and the certainty of achieving it. Chapter 11. The AI Investment Checklist. Everything we have covered in this book converges in a practical question: how do you actually decide whether to invest in a specific company in the AI era? The answer is a disciplined analytical process, and the most useful tool for imposing discipline on that process is a checklist. A checklist does not guarantee good decisions. but it ensures that you consider the relevant factors systematically rather than being driven by enthusiasm, narrative, or the noise of the moment. What follows is the AI investment checklist that synthesizes the key principles from the preceding chapters. The business model questions. The first section of the checklist concerns the fundamental business model. What does this company actually do, and how does it make money? This seems obvious, but AI narratives can obscure the reality of a business model, and you need to be able to describe the business in simple, clear terms before you can evaluate it. What is this company's relationship to artificial intelligence? Is it an enabler, building the tools that make AI possible? Is it an integrator, embedding AI into its existing products? Is it a beneficiary, gaining from proximity to the AI economy? Or is it primarily a company with an AI narrative attached to a business that is not fundamentally changed? Has AI already changed this company's financial results in a measurable way? Or is the change still projected into the future? This is the revenue test from Chapter 2, and it is the most important single filter in the checklist. The competitive position questions. The second section concerns the competitive position. What is this company's competitive moat, and does AI make it wider or narrower? A company whose moat is widened by AI because it has proprietary data, superior technical capabilities, or platform advantages that AI amplifies is in a structurally stronger position than a company whose moat is being eroded. Who are the main competitors, and how are they positioning around AI? A company that has a significant AI lead over its competitors today may lose that lead if competitors have the resources and technical capability to catch up. The sustainability of the current AI advantage is a critical factor. Are there new AI native competitors entering this company's market? AI native companies, those built from the ground up around AI capabilities, rather than adding AI to an existing product, sometimes have structural advantages over incumbents. If AI native competitors are gaining traction in a market, that is an important risk signal. The financial questions. The third section concerns the financial fundamentals. What is the current revenue, and what fraction of it can be attributed to AI in a meaningful way? This is the specificity test. Companies with genuine AI revenue can answer this question. Those with narrative AI can only speak in generalities. What is the gross margin, and is it improving in ways that suggest AI is creating efficiency gains? Improving gross margins are one of the clearest financial signals of genuine AI benefit. What is the company's capital intensity, and is it investing its AI-driven productivity gains in growth or in margin improvement? The allocation of AI-generated economic benefit tells you about management's confidence in the growth opportunity. What is the balance sheet position? Companies with strong balance sheets can afford to invest in AI capabilities over a longer period without being forced into dilutive capital raises. Companies with weak balance sheets face more urgent pressure to show results from AI investments. The valuation questions. The fourth section concerns valuation. What is the current stock price implying about future growth and profitability? Work backwards from the current price to the future results that are necessary to justify it, and ask whether those results are plausible. What are the key assumptions embedded in the current valuation, and what happens to the value if those assumptions are wrong? This is the scenario analysis discipline from Chapter 10. A good investment should offer reasonable value even under moderately pessimistic assumptions. Is the company cheap or expensive relative to its peers? Relative valuation does not tell you whether the absolute level is right, but it tells you whether there are better values within the same opportunity set. The risk questions. The fifth section concerns risks that are specific to AI investments. Is this company's business model vulnerable to AI disruption from outside its current competitive set? This is the disruption check from Chapter 8. Even companies that are currently using AI effectively can be threatened by AI-native competitors with a fundamentally different approach. Is there significant geopolitical or regulatory risk associated with this company's AI activities? Regulatory risk is growing in the AI sector, particularly around data privacy, algorithmic fairness, and the use of AI in sensitive domains. Is there concentration risk in this company's AI strategy? A company whose AI capabilities depend on a single model provider or a single infrastructure partner is exposed to the risk that the relationship changes in unfavorable ways. Applying the checklist. The checklist is a starting point, not an ending point. It prompts the right questions and ensures you have considered the relevant factors. But answering the questions requires judgment, and judgment is developed through experience, study, and the honest assessment of past decisions. The investor who applies this checklist consistently, who insists on answers before committing capital, and who is willing to say no when the answers are unsatisfactory, will make better AI investments over time than the investor who buys based on narrative and enthusiasm. Chapter 12. Building an AI-aware portfolio. Everything in this book has been building toward a single practical output, a portfolio that is thoughtfully positioned to benefit from the AI transformation while managing the genuine risks that accompany it. Building an AI-aware portfolio is not the same as building an AI-focused portfolio. An AI-focused portfolio concentrates everything in AI-related names, maximizing exposure to the upside, but also maximizing exposure to the risks, including valuation risk, regulatory risk, and the risk of picking the wrong winners in a fast-moving competitive landscape. An AI-aware portfolio does something more sophisticated. It takes into account the way AI is reshaping every industry, and it builds positions that reflect that understanding across a diversified set of companies and sectors. Some of those positions will be direct AI plays. Others will be in non-AI companies that are benefiting from AI-driven tailwinds or that are defensively positioned against AI-driven headwinds. The layers of an AI-aware portfolio. Think of an AI-aware portfolio as having several layers, each with a different risk and return profile, and a different source of AI-related value. The first layer is infrastructure exposure. As we discussed in chapters 3, 4, and 5, the companies building the physical and technical infrastructure of AI, the chip designers, the data center operators, the cloud providers, are participating in a sustained and visible demand cycle. This layer provides relatively broad AI exposure without requiring you to pick specific application winners. The risk in this layer is primarily about valuation and the pace of supply coming online to meet demand. The second layer is integrator exposure. These are established companies across various industries that are successfully embedding AI into their products and business models in ways that are creating durable economic advantage. This layer requires more specific analysis because the quality of AI integration varies enormously across companies, even within the same sector. But well-chosen integrators offer the combination of stable underlying business value and meaningful AI upside. The third layer is emerging opportunity exposure. This layer involves smaller, earlier-stage positions in companies that represent specific bets on AI applications that you believe are undervalued by the market. This layer carries higher risk and requires more careful position sizing, meaning you should commit less capital to each position in this layer than you do in the more established layers. The potential reward is also higher because the market has not yet fully reflected the value of these companies in their prices. The fourth layer is defensive positioning. This means underweighting or avoiding companies that are in the disrupted position, those whose business models are structurally challenged by AI. You do not necessarily need to short these companies, which involve specific risks of its own, but reducing exposure to them relative to a benchmark index is a meaningful form of active positioning. Concentration and diversification. One of the most important portfolio construction decisions in the AI era is how much concentration to allow in AI-related positions. The case for concentration is that AI is genuinely transformative and that the companies best positioned to benefit will create enormous value over the next decade. Concentrating in the highest conviction ideas maximizes the potential return from being right about this. The case for diversification is that the uncertainty in AI investment is genuine and substantial. Which specific companies will win, how quickly the economics will develop, how competitive dynamics will evolve, and what regulatory frameworks will emerge are all genuinely uncertain. Concentration magnifies both the gains when you are right and the losses when you are wrong. Given the uncertainty, a diversified approach that captures the AI transformation broadly is a more reliable path to good outcomes than a concentrated bet on a few names. For most investors, the right answer is somewhere between these extremes. Sufficient concentration to benefit meaningfully if your best ideas play out, but sufficient diversification to avoid catastrophic outcomes if specific bets go wrong. The exact balance depends on your risk tolerance, your investment horizon, and the quality of your analytical process. The rebalancing question. Building an AI-aware portfolio is not a one-time exercise. The AI landscape is evolving rapidly, and a portfolio that was well-positioned one year may need meaningful adjustment the next. Rebalancing an AI portfolio requires the same analytical discipline as building it in the first place. When a position has grown to represent a large fraction of the portfolio because its stock has risen significantly, you need to ask whether the current price still offers value given your updated analysis of the company's position. If the price has risen faster than the underlying business has improved, the position may deserve trimming even if you remain optimistic about the long-term story. Conversely, when a position has declined because the market has become pessimistic about a company you have analyzed carefully, you need to ask whether the pessimism is warranted or whether it represents an opportunity to add to the position at a more attractive price. This discipline of ongoing analysis and adjustment is what separates a thoughtfully managed AI portfolio from a collection of AI-related bets made at a specific point in time and never revisited. The long view. The final point of this chapter and this book is perhaps the most important. The AI transformation is not a trade. It is not a theme that will play out over one quarter or one year. It is a multi-decade restructuring of the global economy, and the investors who approach it with a long-term perspective will have significant advantages over those who are trying to capture short-term moves in AI-related stocks. The companies that build durable competitive advantages based on AI capabilities will compound value over time in the way that truly great businesses always have. The investors who buy those companies at reasonable prices and hold them with patience and conviction while the thesis develops will participate in that compounding in a meaningful way. This is not easy. The market will give you many opportunities to doubt your positions. There will be periods of AI enthusiasm when AI stocks rise to levels that seem excessive and tempt you to sell. There will be periods of pessimism when AI stories fall apart and tempt you to give up on the entire thesis. Navigating these periods requires the intellectual anchoring that comes from having done the analysis, from understanding the business you own and why it should create value over time, and from maintaining perspective on the long arc of the transformation even when the short-term market is noisy. The AI era is not a story that is close to its ending. We are in the early chapters of a transformation that will redefine industries, reshape labor markets, restructure supply chains, and fundamentally alter the economics of competition across almost every sector of the global economy. The investors who understand this transformation deeply, who think carefully about which companies are genuinely benefiting and which are genuinely at risk, who value assets with discipline and buy with patience, will be well positioned to participate in what may be the most significant period of value creation in the history of modern capitalism. The tools to navigate it are in your hands. The analysis is your work to do. And the opportunity, for those who approach it with the right combination of knowledge, discipline, and long-term perspective, is genuinely extraordinary. A final word. The story of artificial intelligence as an economic force is still being written. Every year will bring new developments, new surprises, new companies that emerge from nowhere to define an industry, and new giants that stumble in ways that seemed unthinkable. That uncertainty is not a reason to stay on the sidelines. It is the reason that careful, informed, long-term investors have an advantage over those who react to headlines and follow narratives. You have now built a framework for thinking about AI and investment that most market participants do not have. Use it carefully, update it constantly as the landscape evolves, and invest with the discipline and the perspective that the size of this transformation deserves. The world is repricing. Make sure you understand what it is pricing in and what it has not yet begun to price at all. Good investing. The AI investor. How to invest when artificial intelligence changes every industry. End of text.